Good afternoon. My name is Chris Swift. On behalf of my partner, Chris Winward, and our sales assistant, Sean Gammon, thank you for taking the time to join us this afternoon. We're going to talk a little bit about the cattle market, the triangular formation, price formation that we're in, and some of the fundamentals that are causing some of these price fluctuations that we're getting. They're really extreme. There is no doubt about that. But what we are doing is we're discovering. We're in a phase of discovery, trying to figure out how we will keep the consumer with beef and not run out of cattle at the same time. Some people who are a lot smarter than we are already started figuring this out 3 years ago. They began increasing the dairy beef cross. And within the last year, we've really noticed it. There's been multiple articles written about it, but know that that came about 3 years ago. And then we come in and we know that with the length of time that it's in the triangle here, probably what we're doing is waiting to see whether or not or when we're going to expand further. Interestingly enough, some that I have spoken with kind of agree with me that it'll be very difficult to expand. I think that two reasons, the biggest reasons are going to be limitations placed upon livestock production and money. Money probably a little bit bigger than the limitations being put on because we're consistently having to deal with limitations put on the cattle. But the increase in interest rates is a big deal. It hadn't been taking place in over 15 years. So now we're having to deal with a new entity that's just costing more. Most of the factors of labor cost more, and labor shortages make it even more costly than anything. So when we look at where we're probably going to go, I don't think any kind of expansion will really even begin to take place until we see what hay production is going to be, how good the pasture conditions are going to be. And that's probably closer to the end of May or 1st of June before we see something like that. Our next probably biggest thing to look for is going to be further limitations on cattle production. We know that carbon credits are a huge ordeal right now, and it's only going to grow bigger. They're more likely than not, the government in order to enforce these, will put the limitations onto the producer, and then they will use either the lenders or banks to be able to enforce that. So you will go and you will apply for your loan, and the bank will look at you and say, well, what have you done for your carbon credit? And if you say nothing, then you will be tossed over to a different side. And if you say, well, I'm doing these things, more likely than not, they're going to say, well, you need to do more of them. So limitations upon livestock production is going to continue to hamper. So what does this mean for expansion? Well, I'm going to tell you a real quick story about my career, and then I'm going to try to relate that to the cattle market. So when I started out in 1988, I was a very young broker, had great ideas of what I wanted to do, but many people told me, said, Chris, this is a dying business. Don't get into it. Be a stockbroker, be a bond broker, real estate agent, do something, but don't get in the commodities. I didn't listen. I stuck with it. And what happened is through the years, they were right. It was a dying industry. But I kept at it because it was the only industry I knew, and it was what I wanted to do for a living. So I just knuckled down and continued to increase my business and to be able to learn more about it and how I could fit into a dying business. 34 years later, I am still in the business and have done fairly well in it, drawing a good client base and being able to earn a living from it. So I will relate that to the cattle industry as a dying business. It truly is. Since 1975, we've not produced a cattle herd any bigger than what it was then. So we have to know that we've lost tremendous amounts of producers. We have lost tremendous amounts of cattle, and yet we still have consumers eating beef and we still have cattlemen. So a little brighter side of it to the industry is even though it may be a dying industry or it may be a shrinking industry, there's still going to be plenty of room for the people that want to be in it. So kind of consider as well that this triangulation in price could give a lot of producers the opportunity to either A, exit the business while we're still kind of at the top end of the price range, or B, buckle down and say, well, if this is the way we're going to have to do business, then I need to find a way to be able to manage the risk on there and be able to perform in a manner with what the future holds. And clearly, we think that some of the future continues to hold the beef and dairy cross. That's going to more likely than not continue to increase. Greater vertical integration. It's going to be very difficult to get away from that because that's what a lot of companies are seeking. We may eventually get investment money into the industry, for which helps a great deal. We see all kinds of seed capital being put into various different industries. There's no reason why the cattle industry can't be acclimated to that kind of seed money as well. It just depends on the vertical integration and whether or not there is a profit margin to be made within that vertical integration. So there's still all kinds of issues out there to be able to take place that continues to contract these prices until we find a level where either the consumer A says, okay, I can now afford a higher price, or I can afford to eat more, or unfortunately, if the price of beef stays high like it is, where we're having to ration it, we're lowering the slaughter pace, which increases the carcass weights on it. It produces less beef to the consumer, keeping that price really high. That is then conveyed into the retail side, into the restaurants, both showing higher percentages of increase in price over the last 2 months. So those factors are more likely than not going to keep beef prices contracting more so than expanding out, because we don't have a consumer that is now flush with capital where we might see them expand in their discretionary spending. We believe they're going to contract further in their discretionary spending. So take a little bit of time to consider what I thought. We know that the three factors there are: we're in discovery. We're trying to figure out how much beef we can grow, how large we can grow them, and how we're going to be able to ration it for long enough to be able to keep the price at a level that we don't kill our consumer demand, but yet we are able to keep our producers with some kind of profit margin on there. So if you have any questions, you want to know anything more about it, feel free to pick up the phone and call us here at Swift Trading, and we'll be happy to help you any way that we can